Hello, welcome to the Real Vision Daily Briefing. It's Monday, March 14th, 2022. I'm Maggie Lake. And here with me today is Josh Lipsky, Director at the Atlantic Council, and Daniel Lacalle, Chief Economist at Trussis. Gentlemen, welcome.
Thank you very much.
Thank
Thanks
you.
for having me.
Yeah, thanks for being here. We continue to see the Russian invasion of Ukraine upending global markets. We saw some volatility today, and perhaps not as bad as we saw in the previous week, but at one point, stocks, bonds, oil, gold, all moving lower. Although it looks like as we close out the U.S. session for equities, they're trying to come back to just about break even. We also, interestingly, saw really heavy selling rather in Chinese tech shares that knocked the Hang Seng down really sharply. I think it's a great place to start just getting an assessment from both of you. And Josh, part of what hurt the Asian shares were reports that Russia asked China for military help, unconfirmed reports. There's been some back and forth on that. Today we learned President Biden is considering a trip to Europe. I mean, on the surface, this does not appear to be a situation that is de-escalating. What's your assessment of where we are?
I would agree. There are no signs right now of de-escalation. There were some rumblings over the weekend about talks, but all that seems to unfortunately have faded away. And you're right. I think China is as much the big story this week as Russia. One, because of the report about the ask for Chinese military assistance, and two, because of the lockdowns that now will be happening in Shenzhen and other cities in China. So all of this is weighing on sentiment. The idea, and this is why I think we're seeing oil come back down a little, that demand might suffer. And we can talk about the supply chain implications and inflation, but just from an oil demand perspective, are we going back to March 2020 now, 2 years later, and this idea of a COVID lockdown situation in the second largest economy? So you have that crisis in China, and then you have the G7 basically isolating the 11th largest economy in the world, Russia, and all the implications of freezing their foreign reserve assets, shutting off exports and imports, what that means for supply chains in the global economy. So two global economic shocks now, back to back. And I think we are entering to unprecedented territory just as the Fed convenes and starts a rate hiking regime, something we haven't seen in a long time here in the U.S.
Yeah, Daniel, and it's really the confluence of all of this, isn't it? That's rolling. It's these shocks on top of what was already a really challenging macro environment. How are you thinking through all of this?
Yes, I completely agree. I think that the problem is that all of this is happening in the middle of a slowdown, and we are putting everything under the umbrella of the Ukraine invasion. However, we need to remember that the developed economies were already showing worrying signs of a slowdown. The Chinese economy is trying to digest what is an inevitable slowdown as well, coming from the burst of an enormous housing bubble. And on top of it, you have the crackdown on the most important sectors. So all of this means weakening of the global economy, and the Ukraine invasion, particularly the extremely severe sanctions that have been imposed, are going to create ripple effects, particularly on the Eurozone. I think that it's inevitable now that we will see a dramatic slowdown in the European economy, which is essential for so many things happening also globally, like the recovery of Latin America, which was also lagging behind. So, a lot of challenges that we need to add to a complex monetary environment in which, on the one hand, you have inflationary pressures, and on the other hand, you see central banks being a little bit prudish about the normalization rate, because the situation can become very volatile, as we're seeing in global markets.
Yeah, let's dig in on that. And Daniel, just let me ask you a follow-up on that, because two really important questions there, both with Europe and China. Let's start with China, though. How vulnerable is China and the Chinese economy? I mean, we're hearing, especially when we're looking at, the cost of energy rocketing up, food supplies. I mean, this was one of the really sort of scary scenarios that started to play out. Some of these projections that certainly we were hearing here from people trying to talk about, if you take the Ukraine supply and the Russia supply of, say, wheat out of the system, how worried are you about the Chinese economy, and what could that lead to in terms of policy decisions on the part of China, given those headlines we've seen with Russia coming to them for aid? Talk to me about that
Uh,
line.
I am worried about the Chinese economy because China had a tremendously attractive opportunity to change the model, the growth model, a few years ago, and politically decided to abandon it because it preferred to continue down the path of massive white elephants and the housing bubble, which is bursting all over the country. And in a country in which the housing market, in which real estate is about directly and indirectly about 20%, 23% of the GDP of the country, you cannot offset it with anything else. Even less so if you add on top of it very severe crackdowns on corporates that are essential to deliver some kind of growth elsewhere. No? So if you put all of that together in an economy that requires almost 10 units of debt to generate 1 unit of GDP, and its dependency on the US dollar, we always forget about China, how scarce it is in terms of its demand for US dollars, and all of that put together, you see commodities rising. You have a surprisingly low figure of producer prices in China, and we can debate whether that is believable or not. But what we can certainly see is that the inflationary pressures in China are stronger than what the official data suggests, and that the economy cannot offset the bursting of a real estate bubble of the size of the one that China has with other sectors. And I think that that is likely to drive a weakening, obviously, of the global economy because of the importance of China in terms of both the exports to the rest of the world and the and its impact on the global growth.
Does that create a situation where Putin is a liability, a greater liability, because of what this is doing to the global economy, the uncertainty around the war, or does it make China more reliant on Russia than we might otherwise believe? We always think China's in the driver's seat.
In my opinion, I think that first, China is not so much in the driver's seat. If it was in the driver's seat, there would not have been a Ukraine invasion, in my opinion. I think also that it is not that easy to move the essential commodities that are used in Europe, that are used in developed economies, move them to China. It takes billions of dollars of infrastructure and changes in the supply chain in order to move the gas from the west to the east. So it's not easy. And I think that the Ukraine invasion is putting a tremendous amount of pressure on supply chains, because we're ultimately talking about two countries, Ukraine and Russia, that are essential for cereals, that are essential for aluminum, that are essential for palladium, that is critical as well for so many different activities, as well as natural gas and oil. The situation for Russia obviously is dramatic. The estimates right now are that the Russian economy is suffering a level of inflation that is close to 20%. It is looking at a collapse of GDP of around 8 to 12% for 2022. And the decision of many countries to try to isolate it further from the imports that many of the developed economies take from Russia is obviously going to significantly hurt Russia even further, but it is also putting strains on the supply chains, and it's inflationary all over the world.
Yeah. Josh, I want you to weigh in here. Do you also share these concerns about China? And again, it's interesting because when you're state controlled, it gives them in some ways flexibility to move all sorts of levers in their economy that maybe other countries don't. But in this case, is it enough? And are they, how wounded will they be, or how stressed will they be based on what we're seeing in terms of the destabilization of the, as you pointed out before, supply chains already under pressure?
Well, yeah, I agree with Daniel. And I think the way to think about this is that people are saying that China will be some sort of lifeline for Russia militarily, economically. China has their own problems, as we've just been discussing. And so they did not need this. They did not need Russia's invasion of Ukraine and all the pressure that puts on them economically and geopolitically. We have Jake Sullivan from the White House meeting with his counterpart now in Italy today. This is not the problem they were looking for, given all the domestic issues they have going on. And the way you know that, you'll hear a lot of political rhetoric out of China supporting Russia, but look at the banks, look at the financial system, look at the way that they support or don't support Russia. They will continue trading with Russia. There's a deep trading relationship between China and Russia. There's a swap line between the central banks. There are FX reserves that China holds for Russia. But they will not go out of their way. They will be cautious on sanctions. China is always cautious on Western sanctions. They will not want to get on the wrong side of that. So the way to think about it is, because of all the issues China has domestically, from their property sector, their slowdown, and otherwise, they will play it both ways, and they will do as little as they possibly can economically to support Russia in the situation, but they also won't pull the rug out from Russia at the same time.
Yeah, well, always watch the money rather than to follow the political rhetoric is a good piece of advice when you're looking at this kind of situation, and certainly looking at Washington. Josh, do you think that we know Zelensky is going to give an address to Congress before there's been a lot of, again, rhetoric and vocal support for Ukraine? Do you think that there's a push on the part of Americans talking to their European allies in terms of maybe going after third parties doing business with Russia? You had Senator Toomey on making the rounds today, saying there's more we can do.
Well, there is more we can do. We've talked about this at the Atlantic Council. There are more sanctions options, but we also have to step back and think what we have done. This is historic and unprecedented for the G7. They basically brought down the heaviest financial hammer they could think of in terms of sanctioning the central bank and wiping out somewhere close to $350 billion of foreign exchange reserves from Russia's account. That's equivalent to the size of Austria's entire GDP. So that was switched off from the bank account overnight, and Russia's economy is in crisis. They are going to default on some of their payments in the coming weeks. I really believe that. And, Daniel said 8 to 12 GDP percent contraction. It could be worse. It could be closer to 20% potentially in 2022. We don't know. It's evolving so rapidly. It's very hard to say. But I think 8 to 12 is even modest and conservative at this point. So they could be facing a historic GDP contraction within the Russian economy. So yes, there's more that can be done. There are secondary sanctions. There are more oligarchs who can be sanctioned. The screws can be tightened further from both the U.S. and the Europeans. Of course, there's oil and gas still from Europe that we can talk about. But let's also recognize that a lot has been done in a relatively short amount of time that surprised me, and I think surprised many observers.
Yeah, and Daniel, it's certainly creating, risks for the economy. The further they go, the more we need to worry about the knock-on consequences for that. We have a question from Ralph from the RV site. How much trouble are European banks in with Russian losses and other headwinds? That's not to mention any margin calls that may come up, counterparty risk if you're looking at failures.
Yes, absolutely. There are significant consequences. We cannot sort of bring them down. I concur with Josh, as he mentioned before, that the impact on the Russian economy might be significantly higher than what the current estimates are showing. In terms of the financial sector, very similar. The financial sector in Europe has about $80 billion of exposure to Russia. That seems very small. It is actually very small relative to the size of the asset base of the European banks, which is north of $3 trillion. However, the problem is that, let's remember, 80 billion was also the exposure to Greece, and it created significant turmoil. So we need to be aware of the ramifications of all of this. And so far, it's very difficult to know, because it's not just the exposure to Russian banks. It is also the exposure to long-term take-or-pay contracts with Russian energy providers, particularly Gazprom. In the case of Italy, Germany, those are important. There are significant liabilities also from on the side of some of the companies. So overall, the size of the exposure is relatively limited in terms of the financial sector, but we cannot say that just because it's relatively small compared to the total asset base, that it will not generate challenges. I think that the ECB acknowledges that as well, because it has immediately implemented a number of backstops in order to prevent liquidity constraints. So we need to see as it goes along. The impact on the European economy is going to be significant. We cannot say that it's going to be small. We know from the past that sanctions have an impact on the European economies, particularly from north to south. But as Josh was mentioning before, these sanctions are completely different. This is a completely new environment. These are significantly more severe. These are the most aggressive sanctions we have seen in recent history. No, in history. And therefore, the impact and the secondary impact on the European economy is going to be coming in three ways. First, obviously, a significantly lower amount of exports to the rest of the world. Second, a very high increase in imports, which obviously will deduct from the component of the external sector on GDP. And third is the ramifications of the slowdown of the economy in general, which goes from north to south, and therefore the exports of the southern European countries to Germany or France, which are critical, will also come down. So there's almost a domino effect that will significantly hurt the European economy. It can go into stagnation and stagflation, actually, more quickly than what we would imagine.
And, this, of course, comes when central banks were prepared to enter a different regime. We heard the ECB sounding more hawkish than many thought. We have a Fed meeting this week, a Bank of England meeting this week. Stephen Van Meter and Peter Bookvar had an interesting conversation this week about the central bank, about the Fed on the platform. I'd like to share a clip for that. Let's have a listen.
I've been saying for weeks that strictly from a market perspective and an economic perspective that we should fear more Jay Powell than Vladimir Putin. Now, Putin, of course, has made Powell's job that much more difficult, but it's Powell and what he does with interest rates and what Lagarde does and what Andrew Bailey does in the UK that is probably more relevant for markets and the economy. And I'm going to throw a question to you because I get asked this as being a critic of the Fed for a long time. I always get the question, well, okay, smart Alec, if you were head of the Fed, what would you do here? So I'm gonna ask you, Steve, if you were head of the Fed, what would you do here?
Yeah,
in light
wow.
of this macro situation.
That's a tough question because that's a job, Peter, I would not want. I don't know about you, but I wouldn't want to be there. I think the Fed has no choice to hike. I don't think they want to. I think if I'm head of the Fed, I think I have no choice here. And the way I look at it is, the Fed's got everything they want going for it. I mean, you've got, high CPI. We just got the JOLTS report today. The number is it north of 11 million still? I forget the actual number. And you start to look at this from an economic perspective, and the Fed has to hike. Now, we know Powell doesn't really want to. I mean, he's been around long enough. He's seen, hey, if you pull back on QE and we really slam the brakes on this thing quick, that the economy needs time to digest this. And just looking at the equity market alone, since the Fed put the brakes on, should give us cause for warning.
And that full interview is available on realvision.com across all tiers today. Daniel, they're in a tough spot, but the market's pricing in 7 rate hikes, I think it is, at last check for this year. Does it seem like the Fed can do that against this geopolitical backdrop that we're talking about?
Well, the Fed is caught between a rock and a hard place, isn't it? On the one hand, inflationary pressures are very strong. There is all the data points that would recommend hikes are there, But at the same time, you have market turmoil, which is very important for the Fed, a lot more than what many would imagine and what they actually should be worried about. And there's obviously the Ukraine crisis. So we have to remember that in 2018, they made a complete U-turn based on geopolitical concerns that were nothing compared with what we're seeing today. So if I was actually quite skeptical that they would go for 7 rate hikes before skeptical today. I think that at the same time, I heard a comment saying that markets should be more concerned about Powell than Putin. No, they shouldn't. No, they shouldn't. I mean, even if we believed the 7 rate hikes that were announced, the interest rates in the United States would continue to be negative in real terms for a very prolonged period of time. And we should definitely be significantly more scared about the Ukraine invasion, because what we're seeing, the ripple effects on the global economy are much larger than a rate hike.
Yeah, absolutely. And Josh, I think we saw that play out, didn't we? We mentioned briefly what happened in nickel last week. There are reports that European energy firms are asking for help, support, maybe to cover their margin spikes. I mean, is there fragility in the global economy that central banks need to worry about? Do you expect them to comment on that at the meetings this week?
I do, and there is fragility, and fully agree with what Daniel said. We need to be concerned about what Putin's doing and the instability that causes geopolitically and geoeconomically. That is the driving factor here. And whatever the Fed does on interest rates will not tip the scales. They will raise rates. They signaled they will raise rates. They need to raise rates. That's not the question in March. They're going to raise by a quarter point. I think that's clear. The question is what happens next. What happens over the 6 weeks? Will they get to the 7? It's just so hard to say right now. But when we think about the fragility, the Fed really has 3 mandates. We talk about 2 mandates for the Fed. One is, of course, managing inflation. That's front and center of their minds. 2 is maximum employment. That's something Powell is committed to more than any Fed chair in history, in my opinion. But 3, and the sort of unstated mandate, is global financial stability. The issuer of the world's reserve currency takes that seriously, and so does Jay Powell. So I think you're going to hear that strongly from the Wednesday press conference. They are looking what's happening around the world. He is talking to Christine Lagarde. He is talking to Andrew Bailey. This is not something done in a silo. And this is the lessons learned from 2008 and the global financial crisis. You cannot let these things get out of hand. There has to be some global economic coordination. Some of it is outside of their control, but some of it is within their control, and they can get ahead of it.
Yeah, and because we have seen collateral scarcity before. I mean, this is unlike the other crisis, but we have seen the kind of coordinated extraordinary measures even during the pandemic that can be put into place rather quickly. Daniel, how do we separate? Is it possible to separate what's happening due to the crisis or the supply chains with China, especially now these headlines are coming at a time when, Europe and US are exiting some of those extreme pandemic measures? To hear that 51 million people are locked down in China again and not really understanding what that will do to the supply chain. How do we vet out what's happening? And, what part of the market do you think is giving us the clearest view on that? Should we be watching bonds? Is it gold? Is it digital assets and crypto? Where are you watching to get a read on what's happening?
Yeah, from on a macro perspective, what we look at basically is consumer figures and the strength of consumer figures. And in terms of markets, we like to look at the differences in the way in which equities behave in those that are supposed to be the bellwethers for changes in the economic cycle. So those the so-called value side, more cyclical components of the stock market. I think that those are basically where there's starting to see a little bit of nervousness coming from the idea that we are going to be likely in a situation in which the cycle turns, and it turns quickly. And coming back to your point, the financial sector is critical as well. We're looking a lot at what is happening with the bonds. So far, the reaction of bonds is is pretty, I would say, calm. It's not as aggressive as definitely equity markets, but the reaction in the bond market and the reaction in the financial sector bond market is something that interests us quite a bit, because that's where you start to get nervousness when you see some of the most aggressive instruments that were issued, particularly a few years ago, like the COCOs, no, the hybrid bonds with significant components of equity, etc. Interestingly enough, those still behaving quite moderately compared to the risks that we are seeing building up in the market. But spreads are widening, and they're widening probably faster than what central banks would have imagined by being, let's say, by announcing so many times and with so much time what they're going to do.
Daniel, we've seen really heavy selling in European equities over the course of the last 2 weeks. There is a temptation for people to try to look for value in extreme circumstances. Is now the time to do that? Is this a space that seems investable to you if you have a long time horizon, or is there just too much uncertainty and too much we need to understand about what this is going to do to the Russian economy and the counterparty risks that lie there?
I think it's important to sort of try to avoid the temptation to jump in, particularly for one simple reason, is that European equities were, more or less cheap compared to U.S. equities in August, September last year. They're not anymore. They're not anymore. We have significant earnings downgrade regardless of what is happening in Ukraine. And on top of that, something is creeping up that is seriously concerning for investors, which is regulatory risk. For example, you would be tempted to purchase equities in utilities because of the inflationary pressures and the rise in electricity prices. And here comes the blunt force of regulatory risk. And you see that governments in the European Union are starting to talk about price controls, are starting to talk about increasing taxes on the sectors that they perceive are so-called benefiting from the crisis, which they're not anyway. So you need to step back a little bit, look at what is going on with the earnings. One thing that I was particularly concerned about the earnings season in the fourth quarter was the lack of guidance. I don't like it when companies don't give guidance. It means that they don't know what is going on with their business. If they don't know it, I don't know it either. I prefer to wait.
Yeah, and if they didn't know then, they most certainly probably have less clarity now.
Certainly don't
Giving
know anymore.
any indication as we see the refugee crisis spilling over, and there's so many questions about what all that's going to mean. Josh, great question. Will the U.S. be able to smooth over its relationship with the Saudis and the UAE? We haven't even discussed that yet, but that's also in the mix of this.
Oh, it's certainly in the midst of it. Those conversations are happening right now. And I think, there's been a lot of questioning about how the UAE's reacted so far and trying to, be basically even-handed. And the U.S. is pressuring right now to deepen that relationship, and not just with the Saudis and the UAE, but also think about Iran, right? There's been talks about restarting the Iranian nuclear deal that faltered over the weekend. U.S. officials went to Venezuela last weekend to talk about lifting sanctions on Venezuela. This is a little bit ironic when you think about what's driving that. So all of these relationships, from Saudi, from the UAE, from Iran to Venezuela, the U.S. is re-engaging in a way they haven't engaged in years. And I don't think it's going to be so easy, because these countries have multiple poles pulling at them. They have the U.S. in the West, and they have the Europeans, but they also have Russia. They also have China at the same time. And these countries will try to do everything they can to basically stay neutral as much as possible. And they will not try to get on the wrong side of either case. So, I think the U.S. will try to engage, but I don't think they're going to get a lot of tractions from Saudi Arabia or the UAE in the near term.
This is what gets risky, though, if they start going down the road of third-party sanctions. There may be a situation that's not an option. Staying neutral is not an option, and that's where I think the risk really rises. I want to ask you quickly about digital assets, Josh. I know you're looking at all of the implications of regulatory issues surrounding crypto here in the U.S., but a lot of questions have come up on the role of that in this crisis. can it be used for payments? Can it be used to bypass sanctions? On the flip side, is it a store of value that is going to, move opposite of others and perhaps a place to find safe haven? Doesn't seem like anyone's been able to work it out, or we seem to have some cross currents depending on what day you're looking at it. What are you watching there?
Yeah, cross currents is the right way to think about it. And we studied these closely at our Geoeconomics Center here. So first, if we just think of cryptocurrency, all the sort of conversation we heard a week ago was, can cryptocurrency be used as a means of sanction evasion in Russia? And I think the answer to that is largely no. In terms of the volume that would be required to do any large-scale sanctions evasion, this is not the risk. This is not the path that Russians or others are going to be able to evade sanctions. That doesn't mean people aren't trying to convert rubles into Bitcoin. Of course they are. They're trying to convert rubles into anything that's not rubles right now. But this is not the outflow and some workaround against the sanctions regime. But there's a broader question here, and that's if what the U.S. and the West is doing with the dollar and the euro and the yen is going to force countries to think about alternative financial systems. And China has SIPS, which is its sort of alternative to SWIFT, but actually relies on the SWIFT payment system. So that's not really an option. But what China does have, and this is what we look at, is central bank digital currency. There are 90 countries now exploring a central bank digital currency. And over time, if those countries could build wholesale bank-to-bank central bank digital currencies, that's not ready yet. But over time, if they could build it, that could be an alternative to the SWIFT system. So the way I see it is cryptocurrency, not a risk of sanctions evasion, central bank digital currency, not ready for prime time, but can be in the near future. And I think what's happened in the past few weeks will accelerate development on those technologies.
Does it open the door to a more positive conversation here in the U.S.? Because certainly they realize that as well, an alternate to the dollar system. And if they're not involved, they're going to be left out.
Well, that's exactly why you saw the Biden administration last week have this executive order on digital assets. And there were a couple lines that jumped out at me. Digital currency based on democratic values. I think we all understand the signal that line is setting. And international standard setting and cross-border experimentation. The U.S. was nowhere on a digital dollar 2 years ago. Last week, the Biden administration said it was an urgent national security priority. So I think that tells you a lot about where the U.S. is headed. They see the geopolitical landscape and the economic landscape as well.
And that's the key, the national security aspect, which many had been arguing, but had been falling on deaf ears. And some of the consumer protection side of it concerns were reigning the day. But now perhaps the conversation centered on that. We're almost out of time. Daniel, I want to ask you, a lot of people are trying to figure out, what do I do in this environment? How can I protect my portfolio? What do I need to be looking at? What's your advice to that? Or what seems like a defensive posture right now as we look at these incredibly volatile markets? I mean, some of the moves we saw in commodities, it's not so bad today, but they've been incredible and I think really frightening to people, even some people who have experience. Well, what are you telling people?
Well, what we're saying is we're long-term investors. So what we want to have is a portfolio that has, and I use a sports analogy. You need goalkeepers, you need defense, and you need attack. The goalkeeper and defense is gold and the dollar. You need to have gold and dollar assets. And because in this environment, and I think it's proven by the way that in which the market has debunked the idea that the ruble was a safe currency because of its large gold reserves, well, that is gone. Thank you very much. So we need to have dollars, we need to have gold, we need to have, and we need to have an attack, and we need to have cyclical exposure. And where do we find cyclical exposure? Not looking at the past. The cyan coals of geopolitical risk always make you look at the past, look at banks, look at oil companies. No, look at the future. Look at the companies that are in cybersecurity, the companies that are in the companies that have to do with defense and with artificial intelligence. Look at technology, sustainability, and look at digital assets, because the crypto world is attractive and is starting to be more attractive, particularly as what Josh just mentioned becomes a reality. Because once central bank digital currencies come to the picture, then the destruction of purchasing power of fiat currency that we're seeing right now will be uncomparable with what we will see in the future.
Wow, I have to ask you, Daniel, in that, and we'll have to do a whole show unpacking that last statement. But you mentioned sustainability. Are you referring to ESG because a lot of people pronounce that dead as of last week?
Oh, but we don't like the concept of ESG when it means loss making. We don't like the concept of technology when it means no profits. We like the concept of sustainability when it means businesses that are generating better solutions for access to water, better
Yeah.
solutions for access to energy, solar and wind. We're talking about profit making companies, not greenwashing, loss making entities or no profit businesses. That is something that we don't invest in.
Yeah, I think that's a really important distinction because it's easy to paint everything when you say sustainability,
Yeah.
in that light, but you're really talking about innovation solving the world's biggest problems.
Absolutely, absolutely. Not just things that sort of try to paint a picture or create a PowerPoint slide out of what is not a business. We want real businesses with real cash flows and with strong earnings growth.
Yeah, fantastic point. And there's a lot of interesting things being done in that area. So I think that's going to be really fascinating to sort of tease out what exactly that means and separate those two things is going to be really important. Thank you both so much for this fantastic conversation and for being here today. We really appreciate it.
Thank you very much. It's been a pleasure.
Thank you.
Great insights. And thank you all for watching. Thanks for the questions. We will be back same time tomorrow. Warren Pye is going to be here with Tony Greer, so be sure to tune in. And of course, the conversation continues on the exchange on realvision.com. In the meantime, take care and good luck out there.